Hello everyone, welcome back to another FinMeUp Weekly Stock Watch where we cover the most important stock market news that happened during the week. Let's get into it. First of all, we're going to cover South African news and then the US, a few companies in the US, but mainly going to focus on Nvidia. Nvidia posted some crazy guidance actually. The share price rocketed, but we're going to touch on that in detail. So stay tuned and skip to the parts that you want to see. First of all, Netcare. Revenue for the period was 11.5 billion rand, an increase of 11.9%. Operating profit increased by 32.5%. Group EBITDA increased by 24%. Profit for the period increased by 48.7%. And headline earnings per share increased by 31.5%. Lots of numbers, lots of growth. It looks good from the rough overview. Paul, any comments on Netcare?
Yeah, good morning, Higgo. Saying hello from Cape Town. As you can see, what a beautiful painting behind me. Weird times at the moment, Higgo, but I love South Africa and I really hope for the best for us and especially the stock market, of course, going forward. So let's get into it. So Netcare, firstly, of course, we have three big hospital groups in South Africa, Life, Netcare, and of course, the big one, Mediclinic. And hospitals operate much like a hotel. So you have high fixed cost and it's all about occupancy rates. You want people living in your hotel, in this case, coming to your hospital and then sorting it out. Post-COVID, we're back to normal. We had this weird COVID times where hospitals were very full and then no one went to the hospitals. And then everyone went to the hospitals and then no one went to the hospitals. Now we're kind of back to normalized levels, no more masks. People are going back to hospitals for stuff like surgeries, like it's something weird with your eye. Now you're actually going to go to Netcare or Mediclinic, and you weren't going to go in COVID. So that's a good thing. I think it's good results. I mean, looking at 48% increase in profit, and that's compared to the previous year, which was also kind of back to normal. But I have my one friend and analyst, Christian Botma. I'm coming to chat about it on Stock Savvy, and he's an expert, and Netcare is one of his biggest holdings. He's quite bullish, but I looked at the share price graph and it's not pretty. So the last 3 years or so, many stocks after COVID, they took a slump and then they recovered nicely. Netcare took a slump and they've been kind of trading flat for the last 3 years. So maybe there's potential for a turnaround. Let's see what happens, and let's chat to Christian Botman.
One thing about hospitals, same as food retailers, they will always be there as there will always be a demand for them. So that is the one thing, but it's a massive operation. Next company, Famous Brands, a company that you've probably been at. Well, you'll see now why I say so. So they've got various brand names like Steers and quite a list of South African food companies, franchises. So their revenue increased by 15%. Operating profit increased by 37%. Dividends per share increased by 82% to 3.63 Rand. Headline earnings per share increased by 37%, and the company focused on value offerings, great deals, loyalty programs, and expanding delivery services to adapt to changing consumer expectations. The group total borrowings remained stable at 1.1 billion rand, and the African and Middle Eastern market faced headwinds, but home delivery gained traction in several countries. That's the thing. Home deliveries, they also mentioned that they're expanding delivery services. It is just so comfortable sitting in your home, going on Uber Eats or going on Mr. Delivery, whatever you use, and just sitting on your couch, watching Netflix and ordering food. So that's the one side. The second side is, so we saw the revenue increase by 15%. So, inflation could possibly be contributing to that. But also, if you think about it, with load shedding in South Africa, especially that 6 to 8 slot, that is horrible. 6 to 8 is when you want to make food, you want to eat, and then you can't really make food unless you have some alternative energy sources for cooking. When you can't eat but you're hungry and you're frustrated because it's load shedding and you can't do much, what do? You want the first alternative, easy source to food. Either you go out, get food somewhere, or you order in. Most of these restaurants, like Steers, all of their other brands, benefit from that. People order more because of load shedding. That's just my assumption, and I'm sure that is the fact. You can let us know in the comment, are you ordering more, eating more fast food than you did before load shedding? So the next company to quickly say something about is not the usual news you hear, but that's Coronation Fund Managers. Revenue decreased by 6%. Basic and headline earnings per share decreased by 97%. But that is primarily due to the impact of a tax ruling by the SCA. Due to the impact of the tax ruling, Coronation will not be paying an interim dividend, and in according with the dividend policy, which depends on after-tax cash profit. That is why they're not paying an interim dividend. Paul, what do you think of this entire tax ruling?
Yeah, I mean, let's chat quickly about Coronation itself. So they're a fund manager like 91 or Alan Gray or Cigna, whatever. They make money on admin and management fees based on the value of the money that they manage. Of course, in the recession, that's going to go down, right? So the value of the investments is down a bit. So that's a bad thing. And of course, in a recession, people tend to invest a little bit less and also tend to withdraw more. So not only does the value of the current funds go down, the overall funds, like on base level, also goes down. Finally, performance fees. They can't take performance fees if they don't perform. And I'm a financial advisor. I know how difficult it is to perform in a recession. So the revenue of -6% comes as no surprise. And then of course the big doozy. They have so Coronation has like a franchise overseas as well, and they had a dispute with SARS. They have to pay something like 700 million rand as a fine. They're going to courts now and all of that, but I mean, it's already the news has hit the market. The share price is down, and looking at this, I mean, after tax or earnings per share down 97%. That's tough. That's very tough. So, yeah, Coronation. I actually looked at the share price graph as well. Last 5 years has not been kind to them. They've really not performed very well, and this is almost more a little bit of oil on the fire.
The next company, Bytes Technology Group, is a company that I started looking at in more detail earlier this year after we interviewed David Shapiro, and that was one of his picks. You can check that video. Really interesting company. Nothing extremely innovative. They just basically know their technology and they know how to sell it to corporates and they know how to partner well. But they are just delivering year over year. They are generating the revenues offshore, so it is not an SAN company. So they'll actually benefit from the rand, what we're seeing at the moment. The revenue increased by 26.5%. Gross margin percentage decreased slightly, but it is still 70.3%. Great margins. Gross profit increased by 20.7%. Operating profit increased by 20.6%. Earnings per share, which influences the PE ratio, increased by 23%. And final dividend declared increased by 21.4%. So these results were incredible. It is a global company operating mostly in Europe, and they are just delivering year over year. Recently, a new board member also joined the company with lots of experience. If you look at the directors' dealings, directors have been actually acquiring shares, putting faith in the business and in themselves. The share price recently ran from around 80 rand to now 110 rand. So some really good growth already seen there. But if you look at the PE ratio, yes, it could be argued it is an expensive business. It is around 30, high 20s, the PE ratio. But if you look at the results, continuing year over year, there's a continuous increase in demand for internet services, for data, for cybersecurity, for everything tech-wise, and they know this. But happy to see these results. I actually bought earlier this year, trimmed recently to actually settle some debts for the home loan to come. But as we know, the interest rates. Let's quickly talk on the interest rates while we are at that. To finish off Bytes, really happy with these results. Going to continue following this company and look into the company in more detail. Looking at the interest rate, so the South African Reserve Bank increased the South African interest rates by another 50 basis points, which is basically 0.5%. They did that because South Africa's inflation is still very high, and the rand to the dollar and to all other exchanges are not doing well. So they were almost forced to hike the rates. This is really bad for borrowers, for people with debt. It is good for savers, especially if you have money in money markets or in one of those safe investments. Generally, it is better to save than borrow. But anyway, raise the interest rate. Everybody expected the rand would strengthen, and it didn't. The rand is now at 19 rand 77. We're going to touch on the US now. What do you do with your money, Paul? Would love to get your insights. You want to buy US shares. You are maybe bearish about South African shares, SA Inc. You want to get dollars offshore. But now the rand is at 1977. Interest rates are still hiked up, and inflation is high. What do you do?
Yeah, Igor, that's a really really good question. It's something I've been struggling with personally because I invest my own money and I also invest other people's money. So now we have to make a call. Where are we allocating our capital? Is it overseas or is it in South Africa? Now overseas, the Nasdaq and the S&P has been running this year. The Nasdaq is up about 40% for the year, which is brilliant. So they're running. So usually when that happens, you know it's not going to go up forever, right? And the US is also there's weird stuff going on there. It's not we are in a global recession. So typically you want to take something off the table there and invest it elsewhere. Where's the next thing of value? Now in South Africa, overall, it's looking, very solid. Stocks across the board are trading at very, very solid valuations. But I read a few articles this week, and one of them was the value trap argument from Josh Viljoen. And that's, in my mind, that's a concern because South Africa, even though the valuations look solid, all is not well in South Africa. I love this country, but interest rates are very, very high. Inflation is very high. We have the rand, going to the moon, like you said last time, but in the wrong direction. We have political instability. We have corruptions and stuff like that. And for the first time, maybe it's because I'm getting a little older, or maybe it's, I don't know what, but I get the feeling that people are, in Afrikaans, like we say, they're full now. They are actually considering potentially moving or, structuring their investments, the rich people, to higher weightings offshore and stuff like that. And that is, of course, not what you want to see at all. We want the people to be positive in South Africa. We need the big boys in South Africa to stay in South Africa and invest in South Africa. We also need the big boys overseas to say South Africa is an opportunity. Let's put our money here. And if that does not happen, if South Africa continues to go down this weird spiral, then we're going to see a withdrawal from South African markets, and the JSE will continue to trade flat for many years to come. And that is a disaster, in my opinion. I want South Africa to flourish. I want to invest here because I know this market. But, what can you do at the moment? It's a weird time it's just a weird time. Over to you.
Having said that, so obviously we have load shedding, we've got the government, we've got so many uncertainties, we've got the interest rates, we've got inflation, we've got the rand at an all-time high. Yet we still have some amazing companies on the JSE that generates the income offshore. But now the rand is so high. What do you do with your personal money, Paul? Do you take money offshore? Do you buy South African Inc. stocks? Do you buy offshore companies on the JSE this year? Do you buy bonds? What are you doing with your money right now?
Yeah, that's the $1 million question. It depends. It depends on. So personally, I'm in limbo at the moment. I'm not really sure because if you put all your money overseas, you are essentially betting that South Africa will continue spiraling downwards. The rand will continue to weaken against the dollar, and I don't like that narrative. Maybe it's true. I don't think it's completely true. So I'm sticking to. I quite like bonds at the moment because I don't think South Africa's government will ever default. That then, if South Africa's government starts defaulting on their debt, you have a lot bigger problems than your investments that's not performing that well. So I like bonds at the moment because interest rates are very high, and I don't think it can continue to go up forever. And where bonds are really, really good is in a high interest rates environment. And when you think interest rates will start stabilizing or even decrease, then bonds is a very good investment. So I think we're kind of in that space at the moment. So I like bonds at the moment, 50%, and the other 50% of my money, I'm going 25% overseas, 25% local. Normally, I would go almost everything equity, 80, 90% equity. But in an environment like this, I'm very, very uncertain, and I like bonds. So that's what I'm doing.
Okay, interesting. Now looking at the US, so the Nasdaq closed at its highest level since April 2022, while the S&P 500 closed today at a 9-month high. Just an interesting fact for you. Meta, formerly known as Facebook, has been fined a record $1.3 billion by European privacy regulators over the transfer of European user data to the US. That's a massive fine, $1.3 billion. And now finally, we're going to look at Nvidia, the company I've been waiting to cover. The share price is currently $380. That is up 24% after the results. Crazy move for a company of this size. The market cap is now $940 billion. This is not a small cap or a cryptocurrency, and it's up 24% after results. It's now sitting on a PE of around 200, so it's not cheap. I first bought Nvidia, it was around 2014, at around $9, and it's now $380. So that is around a 42x. Unfortunately, I didn't buy it for my personal funds. I actually bought it for my parents when I was, when I managed their funds. So biggest lesson that I learned from Nvidia was let your runners and your winners run if the fundamentals don't change, if you still believe in the company. Many times we hold a company, goes up 100%, and we feel the urge that we need to sell. But on the other hand, nobody ever lost money taking profit. So, there's two sides to that argument. And the thing is with Nvidia, when the share price, so bought it at $9, ran up massively to around $50, had a massive retraction back, thought, okay, maybe I should sell now, take the profits. Then it went back up. And over the years, it just went up and down, up and down. But if you look at the graph, it's going one way. But I am cautious on Nvidia at the moment. It's trading at a really high valuation. There's a lot of hype around AI. But let's look at the facts. So the facts are the financials. Quarterly revenue of $7.19 billion, so let's say $7.2 billion, that is down 13% from a year ago. So the revenue is actually down year over year, but up 19% from the previous quarter. They posted record data center revenue of $4.3 billion. And the second quarter revenue outlook, and I think this is why the share price saw this massive increase. Their outlook for the next quarter is $11 billion. Remember, they did $7.2 billion this quarter. For next quarter, they're guiding $11 billion. That is huge growth for a company this size, and that's probably why you saw this massive share price run. Looking at the earnings per share, it was down 20% from a year ago, but also up 24% from the previous quarter. So these results year over year did not look great. Quarter over quarter looked good, so it's, maybe we saw the bottom. But looking at the guidance and the outlook, it is huge. Now let's look at some of the comments from the CEO. The computer industry is going through two simultaneous transitions: accelerated computing and generative AI. $1 trillion of installed global data center infrastructure will transition from general purpose to accelerated computing as companies race to apply generative AI into every product, service, and business process. We are significantly increasing our supply to meet surging demand for them. So one thing is clear, we are seeing massive changes in tech, especially AI. AI has been a massive talk for so many years, but now we're actually seeing it. We're seeing it with ChatGPT, Bard, and so many websites using it for video editing, for so many things. So they are seeing a massive demand. They're ramping up supply. Usually I love businesses where the demand is greater than the supply. I love that. Data center revenues was up 14% year over year. Gaming down 38%, so taking some knocks there. Professional visualization, which is like the metaverse stuff, the omniverse, all of that, down 53%, also taking a beating. And automotive up 114%, so really good segment there for Nvidia. Overall, what I think of Nvidia, I think it is too expensive for my liking at this moment. Yes, they are guiding massive growth, but at some point the growth will start to flatten out again, and then they must justify the valuation. At a PE ratio of 200, after running more than 100% just over the last few months, 24% just off the results, Nvidia personally too expensive for me. I've loved this company for so many years. I don't own any Nvidia anymore. Given up on that, but might look to add if there's a massive pullback. Will it happen? I don't know. We'll have to see, but I'm not buying at this moment. But really interesting to see what they are achieving, what they are doing, and where this entire AI and tech industry is moving towards. Before I ask for Paul's comments, you'll probably, I don't know if you can hear, but our puppy is actually complaining because I had to close her for this video. But we are launching FinMeUp's pet insurance product, which is called FinMeUp, in June. It's happening in June. We've already onboarded a few clients who asked for it, and so far some really, really good feedback. It took me less than a minute to insure our puppy and already had a successful claim, so I really can't wait for that. Back to Nvidia, back to the US. Paul, any further comments from your side before we close off?
Higgo, I think everything you said is true. I also invested in Nvidia way back when. I'm not a shareholder anymore. Yes, I missed out on some growth, but the valuation is insane. And you know what? I'm all for technology. I hope Nvidia keeps hitting the lights out for years to come. Nvidia, AMD, all of these tech companies, because that's essentially what drives us forward. as an investor, it's difficult for me to invest in that because it's just in my head. It's difficult to get myself to invest in something that's trading at those type of valuations like Tesla and Nvidia. But like I said, I hope these companies hit the lights out. Then maybe just a last thought, Higgo, on stock picking. So remember, I don't want to sound negative. Even if the stock market trades flat for the next 5 to 10 years, you know what that does? That's a double-edged sword, because that means that stock pickers now has a real opportunity to make some money. Because in an environment where the stock market just goes up by 10-12% a year, what's the best course of action for most people? Just invest in the index. Invest in the index. It's low cost, low risk, and you make your 10-12% a year. Who wouldn't want to do that? But now you have a situation where you potentially can trade flat for 5 years. So now the stock pickers, now the art of investing really comes into play. And I like that. I really like that. So that's a very nice challenge for all of us. I love South Africa, and I think there's brilliant opportunities here.
The nice thing about indexing is you actually benefited a little bit of the Nvidia increase in their share price because they are part of the S&P 500. So that's the one thing about indexing. You get access to so many companies at once. Just a final comment. A question you might have is, because that's the question I have. Semiconductors, we know semiconductors is like an industry that will just be forever increasing, because for technology to happen, for innovation to happen, you need semiconductors. And there are so many big semiconductor companies. So which ones do you choose? First of all, we have baskets on easy equities, especially in the US baskets. We have several baskets where we have specific semiconductor companies in the baskets, but also ETFs that cover the semiconductor as a general. So you can check those baskets. You can click on easy equities in the US and you click on baskets and you can see what is there. But if I had to pick one now, or maybe two, it wouldn't be Nvidia. My first pick at the moment would be ASML, just because they are a monopoly. You can't have the semiconductor industry almost without them. And secondly, I'd probably say AMD. But once again, that is definitely not financial advice, just a personal preference. And I mean, these things have run really, really hard. So it won't be surprised if you see a little bit of a pullback. Thanks for watching. Thanks for being part of it. Consider liking. And if you want to see more of our content, Stock Savvy, where we cover specific stocks. Next up, I'll be covering Santova and more of these highlights. Remember to like and subscribe. Thank you so much for being part of the community. Have a great weekend. Cheers.